Hi everybody, this is Lara with your weekly video for the S&P 500 for the week ending Friday 20th of January 2023. Prices squeezed but are just below resistance, the bear market trend line, and just above support. The last couple of rallies have got a nice clean support line, and so we're going to get a strong indication early next week of which wave count is correct, the main bearish wave count or the alternate bullish. And underneath the daily technical analysis chart, I have a bullet point list for you of evidence supporting either wave count. The bottom line should always be the trend remains the same until proven otherwise. While there is still a series of lower lows and lower highs within this bear market, the basic definition of a downward trend, we should assume the downward trend remains intact. While that bear market trend line has not been properly breached, we should assume it will continue to provide resistance until it does not. And so if that line is breached next week, then my analysis will switch to bullish. There is some support for that alternate bullish wave count. The bearish wave count expects a third wave down to show an increase in downward momentum and make a new low below 3491.58. A midterm target is 3267. The final target for primary 2 remains the same at 3144. The alternate bullish wave count considers the possibility that primary 2 may be over and primary 3 may be in its early stages, its target 7742. And so if that wave count is correct, we're still relatively early on within that new bullish run. This is the main wave count on the weekly chart. It remains bearish. It expects that this bear market is a second wave correction at primary degree, subdividing as a zigzag. Zigzags are labelled A, B, C, and they subdivide 5, 3, 5. Intermediate C needs to complete as a 5-wave motive structure. From this high to this low, this downward movement looks like a really good 5-wave impulse. This upward movement on the weekly chart looks corrective. This wave count now expects a third wave down within a C wave. It should exhibit an increase in momentum. The target remains the same at 3144. Intermediate C would reach equality in length with intermediate A. Within intermediate C, if minor 2 continues further, it may not move beyond the start of 1 above 4325.28. But this wave count will probably be switched to the bullish alternate prior to that price point if this trend line is breached early next week with a full daily candlestick of green, an obvious upward session, not just a little doji or a little bit of sideways movement. It has to be properly breached with upward movement above and not touching this trend line. If that happens, then I will move the degree of labeling within minor wave 1 up 1 degree, which means primary 2 and intermediate C could be over at this low. That's the bullish alternate wave count. Let's take a look at the bearish count at the daily chart level. This high of minor wave 2 is this point up here. This is all of minor wave 2. It fits as a double zigzag. A little bit of a problem with this bearish wave count. The second zigzag hasn't really moved much beyond the end of the first, but it's rather difficult to see this upward movement fitting as anything apart from a double zigzag if it's a correction. From this high to this low, this downward movement has a really good look as a 3-wave structure. It will subdivide very nicely at lower time frames as an impulse, but it does look like a 3. I've added this support line here to this bullish wave count on the daily chart from this low to this low. This is the line that's providing support for the last few weeks. Price is now squeezed below resistance and above support. There should be a breakout next week. Well, I guess price could continue to move sideways in an ever decreasing range with really small little candlesticks. It could do that and really test our patience, but it looks pretty likely that we're going to get either a break above resistance or a break below support next week, and that's going to be a really strong indicator of which of the 2 wave counts is correct. For the short term, minute 2, if it continues higher, may not move beyond the start of 1 above 4100.96. The target for minor 3 is for it to reach only equality in length with minor 1 at 3267, but if that target's wrong, it may not be low enough. Likewise, if this target is wrong, it may not be low enough now. At the daily chart level, this is the idea I outlined for you on the weekly chart. If we just move the degree of labelling within intermediate wave C up 1 degree, then it is possible that primary 2 could have been over at the October 2022 low. That is possible. There is some evidence for this wave count. There's evidence for both wave counts, and we have to weigh it all up and make a judgment. I think next week price is going to tell us. If this wave count is correct, then from this low to this high, this upward movement fits really nicely as an impulse. From this high to this low, this downward movement fits nicely as a zigzag. This looks like a 5, this looks like a 3. This wave count, I might need to move the degree of labelling here down 1 degree though. This could be just minor wave 1 within intermediate wave 1. This wave count now expects a third wave at 3 degrees at minor, intermediate and primary degree, maybe in its early stages. It's really common for the S&P to have very, very long extended third waves, and so this target is still fine for primary wave 3. We might see a really long extended minor 3 within intermediate 3 within primary wave 3, or I may need to move the degree of labelling here down 1 degree. If that bear market trend line is breached next week, then this will be most likely the main wave count, especially if the breach is clear with a good strong green candlestick like we saw for Friday. If we see a breach to the downside of the lower edge of this base channel, and this lower trend line is exactly the same as that support line I've now drawn on the main wave count's daily chart, if price breaks below this trend line, this wave count will decrease in value in favour of the main bearish wave count. That's because lower degree second wave corrections should find support in a bull market at the lower edge of a base channel drawn around a first and second wave 1 degree higher. It's sometimes base channels aren't always respected. They are respected most often. Intermediate 2 may not move beyond the start of 1 below 3491.58. The target for primary 3 is for it to reach 1.618, the length of primary wave 1, at 7742. And it'll probably take at least over a year, if not 2 or 3, to get there. This wave count moves the degree of labelling within cycle wave 5 all up 1 degree. The only evidence in support of this wave count is the extremely bearish divergence between the Nasdaq AD line and price. Nasdaq's making strong new lows below March 2009. Price is a long way off, but when I get to the Nasdaq chart, I'll show you why that's not necessarily definitive. But this is actually Elliott Wave International's wave count. Essentially, I've just added the grand supercycle one here. They've got this as the end of a supercycle degree 5th wave and the start of a huge new bear market. If that's the end of a supercycle degree 5th wave, then obviously that has to end something at grand supercycle degree, so I'm labelling it wave 1. If we're looking at a grand supercycle degree bear market, it should last probably over a decade and be absolutely devastating. There was only 2 months bearish divergence between price and the AD line at this all-time high, and there is a positive correlation between the length of divergence between price and breadth at a high and the depth and severity of the following bear market. A short divergence, shallow, less severe bear market. Long divergence, deep, severe bear market. Only 2 months divergence, we should be expecting a more shallow and less severe bear market, and this is the opposite. So not enough support from classic analysis for me to make this my main wave count. Absolutely not. If this trend line is breached next week, I'll probably not publish this wave count again, but I just want you to be aware it is possible. This week completes a hanging man candlestick. This is a bearish reversal pattern coming toward a little bounce here and at resistance at the bear market trend line, which I've drawn on the classic technical analysis chart. From this high to this high, touches this high, tiny little overshoot a few weeks ago, and last week found resistance just a little bit below this on this chart. This week, resistance again at that trend line, a bearish reversal candlestick pattern. This supports the main Elliott wave count. However, hanging men have a bullish long lower wick, and the bullish implications of that wick mean that in order for confidence in a hanging man, we have to see bearish confirmation in the very next candlestick. So we won't know if we've got that until next week is over. But just for now, just to be aware, a hanging man is essentially one of an effective 2 candlestick pattern. Upward movement this week, a higher high, a higher low, but the candlestick is closed red. A little bit of a decline in volume as price is moving higher, but we really need to look inside this week to have an idea of what this volume profile really looks like. Support holding at 3950, resistance above 4160. On balance volume is making lows prior to price, so there's some bearish divergence here between price and on balance volume. I know there's 2 ways to read this. I read on balance volume in the same way that Lowry's and I read the AD line. I read it as a leading indicator. There are some resources out there that would call this hidden bullish divergence. I'm not going to read it like that. This indicates that there is more pressure to the downside from volume than price is showing yet. And so if that's the case with on balance volume, I'm expecting this is bearish divergence, because where on balance volume leads, price is likely to follow. Not always though, and I prefer to use on balance volume with trend lines rather than divergence, and I'm just noting that it is there. ADX is declining on the weekly chart. There's no clear trend at this time frame. The downward trend back here and here at the low in October, the downward trend did reach extreme. The ADX line did reach above both DX lines, but it didn't reach up to 40. So there was an extreme downward trend. There was some bullish divergence between price and RSI and price and money flow index. So that would support a bullish case. But the bottom line is, while resistance remains intact, let's assume the bear market also most likely remains intact with the series of lower highs and lower lows, the basic definition of a downward trend. We need to have this high breached in order for confidence that that basic definition, this one back here, this is the last major swing high within the bear market. If this is breached, then that pattern would obviously be broken. But I will be bullish with my analysis if this bear market trend line is breached. RSI, money flow and stochastics all remaining neutral, and ATR flat as price whipsaws, having a little bit of a decline now with a little bit of upward movement here in the last few weeks. Bunch of bullish long lower wicks as well still forming here on the weekly chart. On the daily chart, Friday's candlestick ended quite strongly with a little bit of a push from volume. Support now 3950, resistance at the round number pivot of 4000, and above that 4050. There is this bearish divergence between price and on balance volume. We see it more clearly here at the daily chart level. There was some bullish divergence at the lows between price and RSI and price and money flow, and RSI and money flow both did reach oversold on the daily chart, but RSI didn't reach oversold on the weekly chart. So there's a little bit of support for a bullish case there. I've gone back and read through Lowry's reports really carefully again about these 90 and 80% down and up days, and we have a 90% down day here, I think this is the 7th of October, and a 90% up day here, I think this is the 17th of October. There's 6 sessions in between them, a little bit too much for real confidence, but we do have this 180-degree reversal from bear to bull. It's just not as strong as I and Lowry's would prefer it, but they are saying it is somewhat acceptable. This could support a bullish case. The biggest problem though is the average power rating didn't reach oversold, and there is no volume spike at this low, which is normally associated with full capitulation at the end of a bear market. So normal bear market ending conditions aren't looking great down here, but there is these two 90% down and up days. These do support a bullish case. Lack of volume spike supports a bearish case, and I've outlined all the support for each quite carefully there, so I won't just read through that. That's really boring for you. I'll let you guys read it yourselves for those bullet points for bullish and bearish case. On balance volume has no new range, no new signal on Friday. ADX is declining at this time frame, no clear trend. RSI, money flow and stochastics all neutral. Stochastics reaching oversold here. Price just falling a little bit short of support. Price moving up to resistance. Stochastics reached up into overbought. Now it's returning neutral. If price is still consolidating, it's reasonable to expect a downward swing to support about 3,720. Using that approach of support, resistance and stochastics. The AD line is making short-term new highs. Again, a new one again this week. While price has not made short-term highs above this previous short-term high, and the AD line has, I read this as a leading indicator. This tells us that there is more support from underlying market breadth than we're seeing in price. Where breadth leads, price usually follows. If price does make a new high above this previous short-term high, and this is the most important one for the definition of a bear market, but this is the more recent one, then that would mean that the bear market trend line is breached. So if that happens, my analysis will be bullish. For now, the AD line is telling us that is likely. It doesn't have to be though, that's likely. Oh, just quickly going back to the weekly chart level, there was this bullish divergence back here between price and the AD line. That was resolved when price also finally made new short-term highs with the AD line. At this point, there was no longer that divergence, and then we can say it was resolved. This divergence at this point in time is unresolved. And we see it more clearly here on the daily chart. It's quite a strong cluster of bullish divergence. This supports the bullish wave count. It's not really good support for the bullish wave count though. It's some support, but it's not very strong. If the AD line made new highs above this prior major high within the bear market, that would be strong bullish divergence, would strongly support a bullish wave count. On its own, if that happens prior to price making new highs, my analysis could be strongly bullish. And we're going to know early next week, most likely. Between price and price and the NASDAQ AD line, here is the March 2009 lows for price and NASDAQ AD line. This is the end of the global financial crisis and the start of more than a decade-long strong bullish run. NASDAQ is making new lows below March 2009. The S&P 500 has not. However, it's done that before, and it didn't necessarily mean that the S&P had to move into a strong bear market and follow where NASDAQ AD line led. So this is strong bearish divergence, but it doesn't mean price has to make new lows below March 2009. But this does support a bearish case, possibly even a bit of support for that very bearish second alternate wave count. But that's pretty much all. For the very short term, there is bullish divergence between price and the NASDAQ AD line. There's also this bearish divergence between the COVID crash of March 2020. And so that's bearish. But for the short term, there's some short-term bullish divergence. This would support the bullish alternate Elliott wave count. So we can find support for either of those in these charts. We have to map it all out and weigh it all up, and my judgment is that the bearish wave count at this point still is most likely, and we should always assume the trend remains the same until proven otherwise. This week prices moved higher with a higher high and a higher low and a bullish long lower wick, but the candlestick closed red. Inverted VIX has declined, so this is bearish for price. VIX and VVIX this week have both moved higher. There is no new short-term divergence. There is, however, this long-term bearish divergence. VVIX has made new lows below, this is December 2021, whereas VIX has failed to make corresponding new lows, with volatility of VIX. Sorry, I have fixed the colour of this long line. This blue one here should be yellow. This is bullish divergence. But my cache is not showing you the correct chart. It will be correct in the article with the charts for you. Volatility of VIX is depressed. With volatility of VIX depressed, this divergence is bullish for price. So there's some longer term bullish divergence for price. This would tend to support that bullish alternate Elliott wave count. For the short term, for Friday, both price and inverted VIX have moved higher. There's no new divergence. We can see this shorter term bullish divergence here between price and inverted VIX supporting a bullish Elliott wave count. There's a little bit of short term bearish divergence between VIX and VVIX. That's all from me with your S&P analysis this week. I hope everyone's looking forward to an awesome weekend. We are leaving Peru, or trying to leave Peru, starting early tomorrow morning, so we'll be on the road for the next 3 weeks. Shouldn't impact your analysis at all, but I'll let you know if we manage to get safely out. We expect to cross to Ecuador on Sunday morning.